You've worked hard for your money and what you have, and that means that things like interest rate hikes and inflation might be a growing concern for you. Well, here in studio this morning, we've got financial advisor Jonathan McCoy. Jonathan, high interest rates on things like CDs may not be around much longer, especially if we do hit a full recession. How can people invest to keep up with inflation and if the interest rates do drop?
So part of the advantage to having high interest rates now is it's the first time that we've had these, 4, 5, 6% guaranteed rates available to us in probably 16, 17 years. And it seems a little foreign that, banks are able to offer these interest rates, but also insurance companies and other investment strategies are offering better guaranteed rates than they have in that same 16 to 17 year time frame. There are ways to lock in some of these higher interest rates over a longer period of time, because ultimately if inflation does drop, if the economy slows down and these interest rates drop, if you're putting your money into 12, 18, or even 24-month CDs, by the time those CDs come up for maturity, if we've gone through an economic slowdown, you're not going to be able to renew at those rates. So then it becomes more the struggle of how do we keep up with inflation after the fact. And ultimately, we've talked about the runs on banks and things like that, and while people are moving money out of savings and checking accounts into things like CDs, it causes stress on the banking system. So that just all leads to the higher and higher likelihood that we will go through some sort of economic slowdown. And we always preach diversification of assets, and really in its simplest form, diversification for retirement should mean what assets that you have that are safe and secure and still growing at better than the rate of inflation, as well as some of those assets that you can be a little more nimble with and move around in different market positions to also provide for that growth opportunity when it re-emerges after this high interest rate environment settles down a bit.
And speaking of assets, a lot of people still seem interested in precious metals.
Right.
Now, are these really as secure as some of the ads out there make them sound?
Well, you use just the right word, ads, and anytime something is being advertised as heavily as they are right now with precious metals, there are drawbacks, especially with retirement funds. Think about things like required minimum distributions. Well, if you've got literal physical precious metal in an IRA or a 401k, how are you going to carve off a piece of that precious metal to send the tax money that you need to the IRS when you're required to start paying taxes on that money?
Little
challenging, yes. So, precious metals are a decent diversification tool, but by no means do we believe that that should be anywhere close to the vast majority or even a major or significant portion of many people's portfolio, because you can't go and use a precious metal to buy a gallon of milk, for example. So
no, you cannot.
Right. And just ask people that invested in precious metals back in 2010, 2011 was the last time their prices spiked. They went through the last 12 to 13 years with absolutely no return, and we're just now getting back to those all-time high levels. And the idea or the prospect that those values are going to continue going higher over time. It's really, precious metals are kind of a fear gauge, where when fear goes up, precious metals go up, but when fear subsides and things sort of settle down economically, you're going to be left holding the bag when those precious metal values drop.
Social Security and the changes to it are something we've all been hearing a lot about recently. How do you help people plan for those possible changes?
Well, it's always a Q&A. What are your goals for retirement? How much money are you going to expect to need to live on a month in, month out, or even year in and year out basis? And we hear so many times that everyone should wait till they're 70. Everyone should file at 62. Take it as early as possible because you don't know how long you're going to live. None of that is really right for everyone. If you're planning on living on $5,000, $8,000, $10,000 a month in supplemental income, how much of that is Social Security going to pay for? And that can help actually determine what you need to be doing with your retirement investments as well. But the timing of Social Security, we actually do a lot of in-person educational classes around the metro to help people get a better understanding of what are the rules. If you've been divorced, if you're a widow or widower, if you've always been single and you're only going to be filing on your own benefit, or if you get married after you file for Social Security, those all throw different ingredients in the rules. And then we always harp on understanding the tax ramifications with Social Security, because the tax rules with Social Security have not changed since 1983, which means people are getting hit with higher and higher taxes on their Social Security benefits as we go forward.
Well, Jonathan, thanks so much for taking the time today.
Thanks a lot, Grace.
And to schedule a complimentary consultation and submit your questions, visit askouradvisor.com or call 816-548-2000. They'll take your questions and even meet one-on-one free of charge. And if you include your address, Market Advisory Group will send you a free gift.